So, despite encouraging you not to fundraise excessively, or at least not to make it the purpose of your company, um, I thought I'd give you some thoughts on the most effective ways to actually deal with investors and to raise capital. Because obviously, businesses do need to raise capital to get off the ground and to pursue specific goals. I think the most important thing that entrepreneurs might fail to realize, or at least might fail to do, is just to try and get in the heads of investors a little bit. The first thing, I would say, the first mistake that entrepreneurs sometimes make is thinking like, I have a good business, you're going to make money, you should invest. That's actually not a sufficient reason for investors to invest in your business. If you think about it from their perspective, any typical investor will get to make 2 or 3 investments a year. And their goal with those investments is probably to return the fund. For an early stage investor, they want to think at least this company has a shot of returning the fund. And so it's not whether they can make some money on your business. It is, should this be one of the 2 or 3 things they do that year? So it really is an opportunity cost calculation, along with what does the pricing look like? How much of the company are they going to own, and what is your likely outcome? And so with all those things being together, is this one of the 2 or 3 things they should do? So that's number one. Number two, they don't have much time to decide, right? So investors are going to be going through 30 meetings a week, 20 meetings a week. And so if you think about a month, they're probably talking to 100 different companies a month if they're moving at a normal pace. That's a lot to think through, and they have to make very quick kind of snap decisions. And that's where this sort of pattern matching stereotype comes when it comes to investors, because they don't have time to think through things deeply. They're going to quickly try and pattern match what you're doing compared to things they've seen before, people they've met before. And one of the things that entrepreneurs might miss in this pattern matching is investors will look at really small details to try and tell them about you and about your company. So if your slides are a mess, they'll be like, okay, well, that company doesn't really have good clarity of thought. Or if you can't answer a quick question quickly and succinctly, too many words, I don't know if this person is really focused. If you are late, there'll be some questions about why you're late to the meeting. If it seems like you have a little bit of conflict, if you come with a co-founder and there's a teeny bit of conflict, they'll wonder about your team. Like, they will extrapolate extensively based on all kinds of subtle cues that you may not know you're giving. I'm not telling you this to make you nervous, but I'm just trying to tell you, like, we as investors are trying to pick up on every little signal we can, because we don't have that much time with you to make a decision. And so it's important for you to think about the small signals you're sending along with sort of the large ones. I would also say most sophisticated investors will be more turned off by entrepreneurial fundraising games than pressured by them. So this round is over full. We have to make a decision by Friday. We have 8 term sheets. So many people want to invest. You'll be lucky to get in. That kind of thing. It's just been done. We've heard it. And so I think you need to be really careful about that. You're going to be much better off kind of having an open and honest conversation with people, mostly because they want to see you're an open and honest person, because they're trying to think about whether they want to work with you long term. Probably the single best advice I could give you is that given the short time frame in which these decisions are made, the best thing you can do is extend the time frame. And what I mean by that is try and meet investors early. Try to get in touch with them, send them an update on your company, tell them, look, I'm not raising money now, but I will be in 6 months. And so I'm going to tell you, I don't even want to meet with you. Here's a deck about my business. And here's my metrics today, and here's where I plan to be in 3 months. I'll let you know if I hit those in 3 months. And then 3 months after, email them again and be like, remember those targets I set? I hit them. And 3 months from now, here's the target, here's the new targets, and at that point I'm going to be fundraising, so I'll reach out to set up a meeting. And then 3 months later, tell them you hit your targets again. So now, when you reach out to them, they're going to know, remember those cues they're looking for. They're going to know a few things. They're going to know, one, you're persistent. They're going to know you are deliberate about your goals. They're going to know that you had a plan and you hit your plan. And they're going to know your business exists, and they're already going to have thought about the market, your competitors, all those things that really, take time and are spur of the moment when they meet you for the first time, and then you want a decision like the next week or the next day. You're just making it a lot harder for them when you could make it easier for them and yourself if you keep all these things in mind. In a video, that's sort of investors in general. On the next video, I'm going to try and cover some of the things we look at Mucker specifically.